The SPDR Portfolio S&P 500 Growth ETF, ticker symbol SPYG, is an exchange-traded fund, ETF, that tracks the performance of the S&P 500 Growth Index. The S&P 500 Growth Index is comprised of the largest companies in the S&P 500 that exhibit strong growth characteristics. These companies are selected based on their growth in earnings, sales, and other financial metrics. SPYG, like other ETFs, allows investors to gain exposure to the performance of a basket of stocks in a particular market or sector, in this case the S&P 500 growth companies. It provides diversification and liquidity to investors, as well as the ability to buy and sell shares on an exchange throughout the trading day. The fund is managed by State Street Global Advisors and it was first launched on August 22, 2019. The expense ratio for SPYG is 0.04%, which is relatively low compared to the average expense ratio of actively managed funds. The top holdings of SPYG as of 2021 are Apple Incorporated, Amazon.com Incorporated and Microsoft Corporation. These companies are large-cap, technology-oriented firms with robust earnings and sales growth. Together, they make up a significant portion of the fund's total assets. SPYG follows a passive management approach, which means it aims to track the performance of the S&P 500 Growth Index as closely as possible. This is achieved by holding the same stocks as the index in the same proportion. This approach helps to minimize the management fees and expenses, thus keeping the fund's expenses low. The fund is suitable for investors who are looking for a low-cost way to gain exposure to the growth stocks in the S&P 500. Since the fund tracks the performance of the index, it tends to have a similar risk-return profile as the index. This means that the fund's performance will be correlated to the performance of the S&P 500 Growth Index, which can be a positive or negative thing depending on the market conditions. Overall, the SPDR Portfolio S&P 500 Growth ETF, SPYG, provides investors with a convenient and low-cost way to gain exposure to the growth companies in the S&P 500. It is suitable for long-term investors who are comfortable with the risk and volatility of the stock market and who want to gain exposure to the growth segment of the S&P 500.